What is going on, guys? Good morning, good afternoon, good evening. What is going on? All right, so I received quite a lot of questions about yesterday about the mastermind. And so I just wanted to clarify things. Yes, it is application only. We do this to ensure that everyone who wants to be there is there, as opposed to people just signing up and then realizing later that it's not something that they want. So there are a few questions, just a few screening questions, nothing too personal, but just want to make sure that it is that the right people are in there. What? Wait, is YouTube fine? Okay, it should be fine. Okay, as I was saying, we just want to make sure that the right people are in there. So you do have to fill out this screening, and then we are giving early Black Friday pricing, early bird Black Friday pricing to anyone who is signing up now after watching these after watching the accelerator, right? So anyone who's applying and signing up will get the deepest discount, even deeper than the Black Friday discount, which will be in 3 weeks. It's an even deeper discount than that, right? So the Black Friday price is that, the discount is this. So just to alleviate any confusion, I will leave the link to apply at the top of the chat box. So if you go to the pinned comment or the pinned chat in YouTube, that's where you will see it, and you can click and apply. You can do it now, you could do it after the class, but as long as, if you're accepted, and you get the email with the coupon code, as long as you apply this weekend, then we will honor this for you. And the next mastermind will start in January. And for those people that are not part of the Discord, you will have access to the Discord from now until the end of the mastermind, which is in February, right? So hopefully that alleviates some confusion. Again, the application's in the pinned chat. So yesterday we focused on option swing trading. Today we are going to focus on futures day trading, right? Swing trading yesterday, day trading today. Now, a lot of the concepts that we are going to learn today in terms of day trading and how to chart for day trading, a lot of these will apply to options day trading as well. Although the entries, the entry mechanics will be, and the risk proposition will be different for a futures trader than an options trader. But today we're going to focus on futures because this right here is, in my opinion, obviously it's a growing interest in the trading community, and for good reason. One, there are more hours in the day to trade futures, and two, you can use a prop firm and not your own money, which you cannot do with options. The only thing with options that you could do is either paper trade, which is not real money, or risk your own money while you're learning, and you will lose thousands of dollars in the beginning. Whereas with futures nowadays, with the advent of prop firms, this is not the case. You can get a prop account, and it's not paper trading, because if you pass that prop account and you build your account up, then you can actually make withdrawals against your account. If you lose the account, well, it was just a small cost anyway. You can get a prop account for $50 or less, right? So it has completely changed the game, and there are also more hours in the day trading futures, which we will go into. But for those of you that have jobs, which I assume most of you do, having more hours to the day, whether you want to trade Asia session or London session, if you can't trade the New York session, or if you live in Asia or live in Europe and the hours are more convenient for you to trade those hours or your local hours, you can do so with futures. You cannot do so with options, okay? All right, so introduction to futures. What are futures? Futures are a derivative, just like options are a derivative of an underlying. The most commonly traded futures, the most liquid futures, are going to be futures that are based on the indices. So there are two main futures that are traded, or the two most liquid futures that are traded: ES, which is the S&P 500, and NQ, which is the NASDAQ. Those are the two most liquid, certainly not the only futures available. If you go to your broker site, you can see all of the futures that are listed here, right? So you have the S&P 500, NASDAQ. You also have Russell 2000 futures, Dow Jones futures, and then you have metals futures like gold and silver. You have energy futures like crude oil, and you even have agriculture or farming futures, right? Like corn, wheat, etc. Soybean. Now, futures initially were started for the sake of farmers, right? Farmers protecting their crop against any future calamities. So if dealers wanted to lock in a price with the farmers, they can, for instance, say, the farmers can say, we're expecting bad weather this year and a limited supply of corn. So you can buy corn from us now and lock in a price of, say, $50 a bushel. And if the price goes up in the future, we can honor the $50 $50 a bushel of corn. That's really how futures started. Obviously, leave it up to Wall Street to commoditize everything and turn everything into a speculative product. And now we have futures for everything. But the most liquid futures are going to be NQ, NASDAQ, and ES, S&P 500. So you will come to find in this training that what we normally trade, or what we usually trade, are index futures, and then a lot of people like to trade gold. So here is the tick size explained, right? A lot of people, when we're trading futures, a lot of people are confused. How does one make money? How do you know how much money you're making? How do you know how much money you're losing? It's so funny to me that traders get into options first and they avoid trading futures because they think it's confusing, right? You see this all the time, and I'm sure a lot of you are in this space. You enter through options and you think futures are confusing, so you stick to options because that's what gives you comfort. It's so crazy to me because options, you have strike price. You have to pick the strike price. You have to pick the expiration. You have to pick whether it's a call or a put. You can buy or sell a call. You could buy or sell a put. You can then create complex strategies like iron condors and diagonals and debit spreads and credit spreads. It's insane to me that people think that options are easier. Options are way, way harder than futures. And if you joined yesterday, we talked about how options are not, they do not give you an exact representation of your P&L. If I shorted Nike here and I'm taking profit here, how much did I make? It depends on your strike price, depends on your expiration, depends on IV, depends on theta, depends on delta, right? There isn't an easy answer for this. So your risk proposition is always in the dark. Whereas with futures, if I bought the S&P, the NASDAQ here, if I bought the NASDAQ here and my stop limit is, let's just for shits and giggles say my stop limit is 30 points and my take profit is, let's say, 100 points, I know exactly how much money I'm going to be making or losing. Exactly. And it will never change. It's not subject to IV. There's no premium expansion as we talked about yesterday. None of that. It's exact all the time. And if you look here, my target profit is 100 points. My stop is 30 points. The way that you know how much money that represents is by what's called a tick size. And initially, for those of you that don't trade futures, this might seem confusing, but it's going to be the same every time. And once you memorize it, it will never change. So NASDAQ has a $20 multiplier. That means that if 100 points is my target, what's 100 times 20? 2,000. If my take profit hits, I make $2,000 always. It never changes. Not subject to IV, not theta. As a matter of fact, we don't have any Greeks when it comes to futures. If my stop limit hits, it's 30 points. What's 30 times 20? 600. If my stop limit hits, that's minus 600. That's it. It's exact. If we were dealing with QQQ options and you bought a call here and your take profit is here and your stop limit is here, how much are you making or losing? You don't know. And it also depends. Are you trading 0 DTE? Are you trading, do you have 2 days to expiration? Do you have a month to expiration? It boggles my brain how people think options are easier. Options are way harder than futures, way harder. The advantage that options have over futures is that you obviously have access to way more tickers, right? There are not futures for Nike. There are not futures for Tesla. So you have access to way more things to trade with options. And two, swing trading is definitely more lucrative. Swing trading is lucrative, which is what options are superior for. But if we're talking about day trading, futures are way, way more optimal than options, way more optimal. As I said yesterday, if you guys joined, if I'm trading Tesla options intraday, right? And I have no problem day trading options because, like I said, you have access to more tickers and I cannot trade Tesla futures. So if there is a setup on Tesla, I might want to take it with options, right? But if we're making a choice between, say, NASDAQ and QQQ or ES and SPY, it is way more lucrative to trade the futures. And we'll talk about further advantages in a second. But I'm just trying to outline the differences between options and futures. And as I said before, right, if I say that I am trading Tesla and I buy a call here and we get to this point, right? Say that we retrace and get back to this point. The profit at this stage and the profit in this stage can look entirely different, even though Tesla is at the same price level, because it is subject to supply and demand, IV, etc. Whereas when I'm trading NASDAQ, say that price gets here, we retrace, price gets back, it's the same exact profit. We're not subject to any sort of exogenous factors except for, we're not subject to any exogenous factors at all. The only thing you're subject to is the tick size. That's it. So for NASDAQ, it's $20 multiplier per point. For S&P 500, it's 50 per point. And if we go to gold, it's $100 per point. So if I look at GC, which is the ticker symbol for gold, if let's say that this is my, let's say I have a 6-point stop and a 9-point target, right? Or let's just make it 2-to-1, just for shits and giggles. Say I have a 6-point stop and a 12-point target on gold. How much am I going to make or lose? Look at the multiplier. It's $100 per point. So 12, my profit if this hits is 1,200. Always, will never change. And my stop limit, 6, is 600 if my stop gets hit. That will never change. And you're never in the dark about this. You know about this up front. And so it's a lot easier to manage risk. Now, minis versus micros. There are two kinds of, usually for each pair, there are two kinds of futures. There's what's called a mini, which is kind of funny because people think that mini means it's the smaller one. Mini is the regular sized one. Okay. Micro is the smaller one. So for most of the liquid and popular futures, the micro is a tenth of the mini. So for NASDAQ minis, as we said, it's $20 per point. If you go to the micro NASDAQ, it's $2 per point. So back to this example here. Again, let's say that we take an arbitrary trade, 50-point stop, and let's say 100-point target, 2-to-1. Okay. If you're taking this in a mini and you want to enter this trade and it's a 50-point stop, if you're in a mini, 50 times 20 is 1,000. So your stop limit is 1,000. 100-point take profit is 2,000. 100 times 20. Now, if I am, trading prop and I have certain rules and I have to stay within a certain threshold of max loss, or else I'll lose my account. Or if you're trading in real money and this is way more than your risk tolerance, right? Say that you're risking maximum 1% or 2% of your account per trade, and this represents more than that, then you would trade micros. So say that your risk tolerance is $500 per trade. Obviously, you can't trade this mini. This one mini contract will be minus $1,000. So in order to make this half, what will you have to do? You'll have to trade micros. How many micros? Well, if a micro is a tenth of the mini, that means that if I trade one micro, it's $100 stop loss and $200 take profit. But my risk tolerance and my risk size, as I said, let's say is $500. That means I would trade 5 micros to make this $500, and my take profit would be 1,000. So it's very versatile. Your risk management is very versatile. Switching between micros and minis. So like I said, for the most popular tickers, which are really going to be NQ, ES, NQ, NASDAQ, ES, S&P 500, and GC for gold. Those are going to be primarily what you're trading. I know a few traders that do really like to trade oil, and that's perfectly fine. If we want to know what the tick size or multiplier is, for oil, we can go to energy. And you could see here, per point, it's $1,000 per point, right? Per full point. There is a micro for oil, which is $100 per full point. So once you know that, it just, and you're dealing with this every single day, you just sort of memorize it. ES is $50 per point, NQ is $20 per point, gold is $100 per point. It's never going to change. Now, in terms of how much money you need in order to trade this, it's going to differ by exchange. So if you're dealing with a full brokerage like Thinkorswim, which is Charles Schwab, it's going to require the most margin, okay? That's going to be inaccessible for most people because that margin changes slightly depending on the price of the S&P 500 or the price of the NASDAQ. And it could be a lot. So if we look at what Thinkorswim's margin is currently for futures, Thinkorswim futures margin requirements. Is it going to give it to us? It's going to be pretty high. So for S&P 500, I think it's up to 15,000 right now per one contract, per one mini contract. And NASDAQ, I think, is up to 20,000, right? Now, don't get a heart attack because there are futures only brokers. So if you look at Tradevate, and I'm gonna go into prop as well. But if you go to Tradevate, which is a futures only broker, the margins, especially for day trading, are way, way more affordable, right? So for a micro S&P 500, it's $50. For a mini S&P 500, it's $500. I don't know why it's not giving me the full. Okay, there it is. So for a mini S&P 500, it's $500. For a mini NQ, it's $1,000, right? As opposed to Thinkorswim, which will require, I think now will require $33,000 for an NQ, one mini NQ contract. And for ES, it will require $23,000 on Thinkorswim, whereas on Tradevate, the margins are way lower. You do have to close your position before the end of the day. So these are day trading margins here, right? But still way lower than Thinkorswim. Thinkorswim does not have a concept of day trading margins and overnight margins. So for Thinkorswim, whether you're day trading or holding overnight, it's going to be closer to this. Whereas futures only brokers like TradeStation and Tradevate, this is the requirements for day trading. And it's going to be a tenth of this for the micros. So the S&P 500 mini is 500, the micro is 50. For NASDAQ mini, it's 1,000. For the micro, it's 100, right, per contract. So this is the margins requirement here. Now, if you're trading a prop firm like Apex, TopStep, Funded Next, etc., that's entirely different because you are essentially buying a prop account, right? And every prop platform costs something, has a different cost. But essentially, you're given an evaluation account. And if you pass that evaluation, then they will give you a funded account. And you could trade that funded account. And if you, again, every prop has different requirements. But if you grow your account past a certain threshold, then you could start making withdrawals, real money withdrawals. If you lose your evaluation account, then you lose, say it costs $50, then you lose the $50 that you paid for the account. That's it. As opposed to losing thousands of dollars trying to learn. So if you are brand new to this game, I suggest that everybody trade with a prop account. If you are not brand new to this game and you do have money and you would like to trade personal capital, I suggest you open a Tradevate account because Tradevate has the most favorable intraday margins. If you're trading on Thinkorswim, your intraday margins are going to be the same as overnight margins, okay? All right, so what are the pros and cons of trading futures? Exact P&L, as we talked about. This will never change. You know your risk size and your take profit ahead of time. 23 hours a day, 5 days a week. It only shuts down for 1 hour during the week, and that's between 5 p.m. and 6 p.m. Eastern time. Otherwise, from 6 p.m. Eastern time until 5 p.m. the next day, futures are open. Okay. And then from Friday at 5 p.m. till Sunday at 6 p.m. So today's Sunday, right? Tonight at 6 p.m. Eastern, futures are going to open and you can trade them. It's not complex, as I said. The only thing you could do with futures is buy or sell. That's it. No call, no put, no picking the strike price, no picking the expiration, none of that. No out of the money, in the money. It still boggles my mind that people think options are easier. Futures are way easier. The only thing you could do is buy it to long it or sell it to short it. That's it. There's nothing else you could do. It's tax advantaged if you live in the United States. I don't know about the country that you live in if you're not in the US, but in the United States, 60% of futures are deemed as long-term capital gains, even if I'm day trading it, which is crazy. And 40% is deemed as short-term capital gains. Whereas if I'm trading options, it's all going to be short-term capital gains, unless I hold the option for over a year, which most of you aren't doing. You could trade in prop accounts, as I said. And then another pro is that you focus on the same thing every single day. I don't need to have a screener. I don't need to try to pick what stock am I going to trade today. Should I trade Tesla, Meta? Should I trade Microsoft, Robinhood, Palantir? I'm focusing on the same exact thing every day. So there's intimacy with the product that I'm trading. I'm only trading really, for me personally, I mainly trade NASDAQ and gold. That's it. I don't even trade the S&P on most days because because I've been trading futures for a long time, I don't mind the big moves on the NASDAQ. Some people might opt for the S&P 500 because the moves are slower, right? And that's perfectly fine. But for me personally, I trade NASDAQ and gold. That's pretty much it. And so when I'm trading futures, I don't need to have this guesswork of, does this have strong volume today? Should I trade Tesla today? Should I trade Robinhood today? Should I trade SoFi today? None of that. It's just I'm going to open up NASDAQ. If there's a setup, great. If not, look at gold. If there's a setup, great. And that's it. I could trade the same pairs every day. And doing that allows you to gain a certain familiarity with how it moves, as opposed to a stock moves completely differently every single day. So the cons of futures trading, in my opinion, there's only one. The cons of futures trading is the con of futures trading is that swing trading can be a challenge. So I typically don't. I will open up future swing trades on occasion if I'm expecting a shift in the macro picture. So if I'm expecting gold or silver to tank over the course of many weeks or months, I will consider holding a futures position. But it's not for the faint of heart and requires a shit ton of margin. So where on futures only brokers, this is your intraday margin if you're day trading. If you're going to hold overnight, doesn't matter what broker you're on, you're going to be, the money that required to hold that position is going to be this per contract. So that is the con, in my opinion, of futures trading, right? Where I love swing trading stocks, especially if there's a setup and I deem it to be an A+ setup and I'm excited to take it. I want to hold that trade over the course of days, weeks to try to maximize gains. I can't really do that with futures all the time. And most people will not be able to. And if you're trading in a prop account, you cannot. Prop accounts are only for day trading. You cannot hold them overnight. What is considered intraday? Come on, bro. All right. What is day trading? Day trading is literally opening and closing the position in the same day. That's it. Not holding overnight. So sometime within the day, I'm going to be opening and closing the position. Now, we're going to get into the discussion of time frames. We're going to get into the discussion of time frames. But opening and closing during the same day is what's considered day trading, right? For some people, depending on the setup, honestly, there isn't a right or wrong. As you get better with trading, you're going to be taking trades from slightly different time frames. Sometimes there's a setup on the 1 minute. Sometimes there's a setup on the 15 minute, right? So sometimes you're going to hold a position for hours. Sometimes you're going to hold a position for minutes. All of that is considered day trading. If I'm closing my trade before the end of the day, it's considered a day trade. Now, bad news. Why day trading is the hardest form of trading. Let's not kid ourselves, okay? I'm not here to sell you a dream. I'm not here to tell you it's easy. It is the hardest thing you will do. Trust me. But it is rewarding. It's the most fast-paced. Obviously, we're dealing with candles that close every minute or every 3 minutes or every 5 minutes. It is the fastest form of trading. Because of that, it is the most pressure, as opposed to if you joined the options swing trading accelerator, right? We talked about how one of the advantages of swing trading options is that you can set and forget. If I have a particular setup and let's say on Nvidia, I wanted to go long and I had a particular setup, I can literally set my position up and forget it and go work, go hang out with the family, go work out, go do whatever I need to do for the rest of the day. I don't need to sit here and babysit it. You have to babysit your positions when you're day trading. Now, once you get really good, there is going to be less babysitting involved. So I entered this trade on Friday. If you guys are in the Discord, you know that. But I entered a long on Friday. Now, let's say that I have my position set up here. And I get tagged in and it takes a while, whatever. I can, go F off and have my OCO order set, meaning my stop limit and my take profit set. And I can go mess around for a bit, but let's be realistic. Most of you who are day trading are going to sit here and watch to see what happens. And it's a lot. You don't get that set and forget luxury in the same way that you do with a swing trade. You just don't. And not only that, but you are now subject to your emotions with every candle. Most people can't handle drawdown. Luckily, this trade that I entered barely took any drawdown. But if it starts drawing down and you're down $300, $400, people cannot take that. And we'll talk about this a little bit more in the psychology. But I want you guys to understand something. And this applies to swing trading as well. 99% of the time that you take a trade, you will be in drawdown of some sort. It's just the nature of trading. Now, why is that? Well, because you can't time the exact bottom or the exact top. So you will buy something or short something, and it will fluctuate from your entry into your drawdown a little bit before it either works out in your favor or your stop gets hit. And because you can't time the exact bottom to the tick, 99% of the time you will be in drawdown. If you're not willing to accept that, trading is not for you. Now, I'm not saying you should be a pro at accepting that right now, but you have to understand that that's going to happen and really relax within drawdown and keep telling yourself over and over again that this is a feature of trading. Because I cannot time the bottom to the tick or the top to a tick, that means that if my trade enters, it will be in some sort of drawdown. Now, sometimes the drawdown will be comes within striking distance of your stop before reversing. Sometimes it's tiny, like this was 2 ticks in drawdown before it went in my favor. Sometimes your stop will get hit. It doesn't matter. That's part of trading. And if you don't want that, then you shouldn't be trading. But you have to expose yourself to it and understand that drawdown is a feature of entering a position 99% of the time. It just is, okay? As we talked about yesterday, limiting unexpectedness is the most surefire way to control your emotions. The reason that people get rattled is because the chart and their P&L is doing something that they didn't expect. So if I, especially with futures where I know my stop limit and my take profit to the penny every single time, there are no surprises. What makes my heart start to skip a beat is if something is happening that I didn't expect. So if I accepted the risk, and let's just round this up or round this down, but let's say that my stop limit is 60 points. Going back to this, my multiplier is 20 on NASDAQ. 60 points means $1,200, right? 60 times 20. If I'm not ready for minus $1,200 and I didn't calculate this ahead of time and I saw Z enter a trade, so I'm just going to mark it in and I'll worry about the stop limit later. And then price starts drawing down. I'm like, oh shit, I didn't realize this was 60 points. And now you're down $900. That's when you start panicking and you might end up closing it. You might end up removing your stop entirely. You're going to do something stupid as opposed to something pre-planned. So limit unexpectedness and realize that day trading is the fastest form of trading with the most pressure and split-second decision-making. I have to decide if price is here and I'm waiting for this tap, and obviously we'll talk about strategy and entry models and stuff. But if I'm waiting for this tap, instead of me just marketing in because I don't want to miss a trade and then getting surprised later by how big of a move it is until it gets to my stop, my decision making should be quick, obviously, because these are 1 minute, 2 minute, 5 minute candles. My decision making should be quick, but I should also be practiced enough to be able to do this, set this up, know what my stop limit is, read that it's 60 points, have a target, which you could say we're going to target these equal highs. Again, we're going to talk about strategy and liquidity throughout this entire thing. My take profit is 160 points. My risk to reward ratio is 2.6 to 1. Great. These are all very fast decisions. And if you're not practiced enough, you're going to be doing dumb shit. Okay? This is why I say do not risk your own money. Go the prop account route. Open up a prop account. Whether it's Funded Next, whether it's Apex, open up a prop account. Prone to candle watching. Talked about this. You're going to be watching every single candle, which is not good for the soul, by the way. And then tilt factor with day trading is the highest. So if I'm swing trading and I buy NVIDIA and I'm waiting days, it goes up, it goes down, it goes up in my favor, whatever. I'm not really getting tilted because these are daily candles and it takes days for these to form and I'm just sitting here waiting. With NQ, say I enter this and my stop hits. I'm like, shit. Then I try again and my stop hits. Shit. Now I'm fucking tilted. Now I'm going to open up way more contracts to try to get that money back. And you're just doing, hasty emotional decisions. You're making hasty emotional decisions within the course of the day because again, it's the fastest form of trading, and it's very easy to get rattled every single day as opposed to entering a position and waiting days for it to play out. And if it doesn't play out, sure, you may not like it, but you're not in this hamster wheel cycle of stop, hit, enter, stop, hit, double down, stop, hit, add to your losers, right? If I entered here and say that price is going down, I remove my stop limit and I keep adding contracts to average in. This type of shit doesn't happen with swing trading. And this stuff happens routinely with day trading. It's just not meant for the human mind, honestly. You have to think completely different to how we were evolved in nature. All right, setting up your chart. Again, starting to get into the nitty gritty here. Tools that you need: TradingView, a futures broker or prop firm. Like I said, you're better off if you're trading your own capital, go with a futures firm, like a futures only firm like Tradevate or TradeStation. The awesome thing about Tradevate is I can connect it to TradingView and I can trade here. I can trade in TradingView itself. I don't have to switch off the screen and go to my broker. And then news for the day. So we're going to get into how fundamentals differ for futures than they do for options, right? Whereas options, you have fundamentals of the stock, the sector, etc. Not for futures because we're trading the index. So what I mean by this is you need to know ahead of time what are the news drivers for the day. Now, luckily, forexfactory.com has a free calendar. There is one also in TradingView. I personally don't like the way it looks in TradingView, but if you do, that's fine. There are also many other news sites. This is the one that I like. I like the way that it's formatted. But you need to know what news is going on for the day because this, and we'll talk about it more when we start getting into charting and strategy, but the news and the time of the news is super important. Now, it doesn't mean that I'm waiting to see if CPI is bad or good or if consumer sentiment is bad or good. Right? Consumer sentiment on Friday, for instance, came in horribly, but we still ended up taking longs, even though consumer sentiment was less than expected. You'll come to find out when we start talking about liquidity, what drives the market, right? And why news is important. I don't care what the result of the news is. I care that what time the news is and what it is. So all red folder and orange folder news is going to move the markets. Yellow folder, not so much. You can even actually filter this out if you wanted to. Right? We can filter out yellow folder and just stick to orange and red if you wanted to. I also advise that you just stick to the US. If you're a Forex trader, you probably won't be watching this. But if you're a Forex trader, that's different, right? You want to know what's going on with the Canadian dollar and the Australian dollar. I don't care. I only care what happens in the US market. So I filtered it by the US market. I keep the yellow up there just because me personally, I like to know what goes on. But for the markets themselves, you really only need to know orange folder and red folder news. That's it. And all I care about is what time it happens and whether it's important. That's it. I don't care about the result. Like on Wednesday, ADP non-farm employment change came in higher than expected, meaning more jobs than expected. The market still tanked. The result doesn't matter. What matters is where are we on the chart and where is the draw on liquidity. That's all that matters. And the news will likely take you there. So if the market is manipulating to the upside and news comes out, regardless of whether that news is good or bad, that can cause the expansion. If the market is consolidating and news comes out, no matter if it's good or bad, it can either take out the lower liquidity level before expanding or take out the higher liquidity level before expanding down. That's all I care about, is what time the news is and whether it's important. I don't care about the result. So you need access to TradingView. In my opinion, you can use Tradeovate's. Actually, Tradeovate uses the TradingView API, I believe, for their charts. But whatever. You can use whatever you want. To me, as I said yesterday, there is no better charting platform than TradingView. And then a futures broker or a prop firm. I have discounts to all the prop firms. We'll get into that later. Or a futures broker like Tradeovate if you want to transfer real money, because it has the lowest intraday margins. And then a new site, forexfactory.com is my favorite one. Use whatever you like. Nice to have if you're trading the S&P 500 or the indices. JEX data, which is gamma exposure. We talked about this yesterday briefly with regards to options. Maybe we'll get into it today. I don't know. And then access to fundamentals. Yeah, access to fundamentals. And I don't mean fundamentals as in PE ratio, etc. I mean, what is going on in the market as a whole, right? Like, is there a Fed meeting? Are we expecting money printing? Are we expecting a rate cut, a rate hike, etc.? Those types of fundamentals. That was an epic fail. And this is now going to be recorded in the annals of history that I spilled water on my shirt. And I'm going to have to perform the rest of this until this dries up, actually. Looking like someone who's challenged. I guess I am challenged. I can't drink water properly. All right. By the way, if you're wondering why I'm drinking out of a plastic bottle, I had an Instacart order. I did not order this. The driver left an entire case of water bottles with my order and then drove off. Otherwise, I typically don't drink out of plastic bottles. All right. So how to set up your chart for day trading. This is going to be different than what we talked about yesterday for swing trading, right? But support and resistance, it's all based on support and resistance, as we talked about yesterday. But it's the types of support and resistance are very different for day trading than they are for swing trading. So we're going to talk about that. What are the key levels and what time frames are we going to use? Remember, we're talking about day trading here, different than yesterday. All right. So because futures trade 23 hours a day, there's really there is a concept of market open, etc., but we need to pay attention to slightly different levels. When I'm looking at NVIDIA, for instance, and I look intraday, it's not a contiguous chart, right? The market closes at 4 p.m. and then you do have an after hours session, which goes until 8 p.m. from 4 to 8 p.m. And then from 8 p.m. Until 8 p.m. And then from 4 a.m. until market open at 9:30, you have a pre-market session, right? With futures, it's 23 hours. Like I said, it only closes between 5 p.m. and 6 p.m. That's it. So when I'm looking at this, when you look at the time at the bottom, you can see that it goes all the way until 6 p.m. Where am I? Where the hell? It goes all the way until 5 p.m., right? As you can see here. And then between 5 and 6, there's a break, and then it opens again at 6 p.m. So it's a contiguous chart because there's only a 1 hour break. So with that said, we're paying attention to slightly different levels. Now, there are many key levels that we have to pay attention to when we're talking about day trading. And in my opinion, it's much better for you to draw these out ahead of time, maybe on Sunday night, to draw these out ahead of time in preparation for the market. Now, there are indicators that will populate this stuff for you, but I think it's really good practice to draw this out. This is the indicator that I currently use, and it's called ICT Kill Zones and Pivots. It's in TradingView. It's free. Well, is it free? Not if you have the free version. Can you add indicators on the free version, that the community indicators? I can't remember. They keep changing it. But you might need at least the lowest tier of paid for TradingView. Either way, it's this, ICT Kill Zones and Pivots. This is the one that I use, okay? Now, you can see here, what are the important key levels that you have to know when trading? There's Asia session, London session. I want to know the New York Open, New York lunch, New York PM. I also want to know the midnight, 8:30 open, and the 6 p.m. open. I know this is a lot, and like I said, day trading is hard, but I want to know all this stuff. In addition to that, I want to know what is previous day's low, previous week's low, previous day's high and low, previous week's high and low. And I also, this came up on Friday, and we'll talk about this because this was a very interesting scenario. I also want to know, if I'm pulling up a high time frame chart, like on the 4 hour, this clearly sticking out. What is this here? Right? And this factored into my trade on Friday, by the way. So this low was the low from 2 weeks ago, by the way. Stick with me because we will explain all of this. Now, in terms of what time frame that I use, okay, for high time frame analysis, I look at the daily and I look at the 4 hour. Even if you're day trading, you have to know, one, what key levels are around you. So if I'm just looking at the 5-minute chart, right, and I look here, This is Friday. And price is here. Then price starts to break structure. And we'll talk about market structure. Don't worry. Right? Price starts to break structure. I'm like, what is happening? If I was just a clueless dork, I would look at this and be like, oh, I guess we're reversing. Wow, magic. There's a reason that we're reversing from here. The market rarely does something random, right? The market is driven off of liquidity, which we will explain. But this right here is very significant. If I'm just looking at a 5-minute chart, I'm assuming that Trump is speaking or something happened or magically the market is just now reversing. Without the high time frame knowledge that this is a key low. Remember from yesterday, I said, if you know how to draw a horizontal line, you're already halfway to knowing how to do technical analysis. Without knowing that this is a key low, and this is from 2 weeks ago low, I would not have any idea what this is. But the fact that I quickly pulled up a high time frame chart and I see that there's a protruding low right there. I can now say that this is a weekly, either weekly low. I'm going to call it sell side, which we'll explain. But this is a weekly sell side level. So once I have this on the chart, and by the way, in TradingView, for those of you that don't know, when you mark up a chart on the high time frame and you go to the low time frame, that line is still there. So this line is from the 4 hour, right? But when we break structure and start retesting this, remember, support resistance is the backbone of all this. When we talk about ICT concepts or fair value gaps or order blocks or sell side and buy side, honestly, I'm going to show you in this accelerator why it's all just support and resistance. I don't care what anybody says, all support and resistance. And if you were just using support and resistance, as long as you understand the concept of liquidity, you'll be fine, okay? Either way, we break above and retest this area. There's a fair value gap here, which we'll get into. I did not get in here. We also broke market structure. But it's key to know what this is, or else it will just seem random to you. Broke market structure, retested this area. What did we learn yesterday in the swing trading? Break and retest. This is a break and retest. Whether you trade ICT, whether you trade support and resistance, I guarantee you, and I promise you I didn't do this, I guarantee you if I pull up the 921 EMA, you'll see these prices stick to the 921 EMA. I guarantee you that. There's many ways to bake a cake. There it is. I promise you I didn't look at this. So I don't argue with anybody's strategy as long as there's a reason why you're doing what you're doing. Now, I will say that having knowledge of liquidity will supercharge any strategy that you're trading. If you're trading break and retest, if you're trading moving averages, you cannot do it blindly. I still need to know what this is. Why did we stop here? Why are we now trading above it? Why did we break structure here? Is this significant? Because if it is, I damn sure want to follow trend and take this to where it's going. Where is it going? We'll talk about that. Right? So knowing liquidity, if you're day trading, is vital. I don't care what strategy you're using. Trend lines, moving averages, break and retest, supply resistance. You have to know this. If you're going to day trade, you have to know this. Okay? I have a feeling we'll go over 3 hours today. And I can't believe this is free. Even though we're not on YouTube Live and this is a private link, hit that thumbs up. Um, and just imagine what the mastermind is like. This is just a free couple hours course. Imagine we're doing this for 4 weeks, where your trading will be. All right. Let's get into a discussion of what the hell liquidity is. When we look at the market every day, the market is always seeking liquidity. I'm not talking about let's leave swing trading and what happens on the daily chart for a second, even though that is also liquidity. But when we're looking at an intraday chart, what is the market doing? The market is always seeking liquidity. Always, 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 always. The number one question you're trying to answer is where's price coming from and where's price going to? Now, the reason that concepts like double bottoms do not work when it comes to day trading is because of the concept of liquidity, right? I'm going to break it down simply for you here. I would much rather show you than tell you what liquidity is. It's a lot easier. There's a low here. If I'm looking at a textbook and I learned about double bottoms, I'm going to, if price gets here, I'm going to say, wow, I saw this in a textbook. This is a double bottom. I'm going to long this. And I'll set my entry there, my stop, wherever. Right? Thinking that I'm going to long this to take it up because you understand the concept of support and resistance, even if you're a noob. Right? There's clearly a buy point here because this is where buyers bought last time. And so you're expecting that to happen again, right? Price comes down here and takes out your stop. And then it moves up. If you were buying a double bottom from here and you had a stop here and your price and your order was stopped out and then it moves in your favor, right? You were stopped out and then price moves in your favor, you're going to blame anybody but yourself. Oh my God, the market is rigged. It's always against me. Why? Blah, blah, blah. It's because of the concept of liquidity, right? The market is not a video game, meaning it needs liquidity in order to go up. Just because it touched this point does not mean that now it's ready to go up. If institutions, which are obviously the bulk of the market, if they want to go long, what are they doing? They have buy orders, right? Buy orders, buy orders, buy orders. They want to go long, so they have to buy it. Who's going to sell it to them? If you want to buy here and they want to buy here and everyone wants to buy here, who's going to sell it to them? You need sell orders for those buyers in order to generate liquidity to go up. What's all this? What's all this here? These are all sell orders, right? If someone is placing a buy order here because of a double bottom and they have their stop limit here, wherever, these are all sell orders because if you're buying here, what is your stop limit? Is your stop limit a buy order or a sell order? It's a sell order, right? Because you're buying here. You're going to sell here if your stop is hit. So why do bottoms often look like V shapes? It's because all of the buy orders are getting filled by sell orders, and it's doing it quickly. So back to the question of if institutions want to long here, at this level and everyone wants to long here, who's going to sell to them? Well, there's a bunch of sell orders below this. And that's where the sell orders are going to come from. And that's why when you look at a recovery from the bottom, it often looks like a V shape because it happens quickly. All of these sell orders get executed into buy orders, and then those buy orders turn into a move up. Okay? That's why liquidity exists. So the market is always seeking liquidity, because without liquidity, the price would just be flat. There has to be a disagreement between buying and selling, more sell orders and buy orders and vice versa, in order for the market to move, right? The market is an auction. So the reason that the market, if you're looking intraday, if we look intraday, the market is just doing this, right? Liquidity, 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 liquidity. So if you look at this, that liquidity was swept, we go down. That liquidity was swept, we go up. That liquidity was swept, we go down. That liquidity was swept, we go up. That's all it's doing every single day. The market is seeking liquidity. That's it. So that is the best way that I can explain liquidity to you. The main question you're trying to ask every day: where is price coming from? Where is price going to? That's it. That's all you're trying to answer, right? When to buy, when to sell. That's all you're trying to answer. So if I know where's price coming from, and I know that because I understand liquidity, and I know where price is going to, that's my order. Price is coming from, that's where I'm going to place my entry. Where's price going to? That's where I'm going to place my take profit. That's it. All right. Now we have to drill down a bit further and talk about different types of liquidity, because they're not all the same. There are different ways to recognize it, right? Which then lead to different entry models. You can enter trades off of fair value gap. You can enter trades off of what we call a breaker, but basically a break and retest. You can enter trades off of the sweep of a certain level. There are different types of liquidity. And this is where it really helps to know this stuff, because it makes your trading that much more precise. So highs and lows, obvious, right? When you have protruding highs and lows, regardless of time frame, these are obvious potential areas of liquidity. That low is a potential liquidity. That high is a potential liquidity. That high is a potential liquidity, right? Now, the misunderstanding that occurs with new traders is they don't understand that not every liquidity level is the end all be all. Okay. Here's what I mean by this. So this is a major, like I said, it's a 2 weeks ago area of liquidity, major. It's the low from 2 weeks ago. And this is a little bit advanced, but this is considered a sell model where you start at one point, you move up, and you complete the round trip back down. Okay. This is called the sell model. Now, say we hit this area here. Does that mean that I expect all the time to hit this area and then move back down to this low? No. Say we hit this level here. Does that mean that I expect this to move all the way back down? No. There are such things as internal liquidity levels, right? Meaning if I hit this level, yes, obviously it's possible to go all the way back down here, but it's also possible to hit this level and trade into a fair value gap before moving higher. So I think the mistake that noobs make is deeming every liquidity level as the most important and that they're going to get the biggest move out of each entry. And that's not the case. And this is why it helps to know to have a high time frame bias to align with your entries, to know what is what is the larger move. And it also helps to be able to humble your targets. So let's say that price moves into here, right? And let's say that we get a reaction, and on the low time frame we get an entry confirmation. We'll talk about entry confirmations and entry models and all that, right? Am I going to then just assume that we're going to go down here and that's going to be my target? No. We do have a fair value gap right here, and we will talk about fib levels as well. Let's say this is my entry, that's my stop. And I confirm this on the low time frame. If I can get a 2-to-1 to this next area of liquidity, which is this fair value gap, I'm taking that trade. What newbies do a lot of times is they think that every trade is going to play out to the max. And so they have these unrealistic levels. But you have to recognize that there are different types of liquidity, and that, you know, the market can really swipe this, get to this fair value gap, go higher to this area. Maybe this trades back into this fair value gap, goes higher. So liquidity is happening not only on the broader scale, it's also happening on the micro scale, right? So you have different types of liquidity, highs and lows, intraday, both intraday, as well as a higher time frame. You have fair value gaps, which we'll talk about. You have key previous levels. So previous day high, previous day low, previous week high, previous week low. Those are important, as well as the internal levels. So London high, London low, Asia high, Asia low. And then you have RTH gaps as well. These aren't the only types of liquidities. There are volume imbalances and whatnot. Don't have time to get into all of that. But just know that there are different types of liquidity, right? And RTH gaps are regular trading hours gaps. So if you switch your chart to regular trading gap, and that's part of the reason that I took the trade on Friday, was to fill the regular trading gap. Because futures trade 23 hours a day, the electronic trading hours shows all the trading from 6 p.m. until 5 p.m., 23 hours. RTH gaps also are a form of liquidity. And the RTH gap is removing everything from 4 p.m. until New York market open, which is 9:30. So it removes all of that price action, which oftentimes leaves a gap, because in between 4 p.m. the previous day and 9:30 a.m. the next morning, there's usually either price action to the downside or price action to the upside during that time. In this case, the price action was to the downside, but the regular trading hours setting removes all of that, and you spot, or it uncovers these gaps here. And this oftentimes is a draw on liquidity. So the way that I read the trade on Friday was we swept this major area that I spotted on the high time frame. We broke structure, retested, that's my entry, break and retest. And where are we going to? We're going likely to the next major area of liquidity, which is the RTH gap. All right. I'm wondering if we should take a break. There's a lot to digest here. Let's take a break here, okay? It's 12:20, 12:18 Eastern time. Let's come back at 12:35. So 15 minutes. Okay? We'll be back at 12:35. We'll take a break and then we'll start diving into fair value gap, market structure, change in the state of delivery, Fibonacci, day trading strategy 1 and 2. We'll start diving into all this stuff. See you guys in 15. Don't leave me. So come back at 12:35 p.m., 15 minutes. What is going on, guys? Hopefully you had a nice break. um, Dario says one of the most enlightening couple of days in education. Thanks. Appreciate it, man. Really means a lot. Shit, I forgot to get more water. 1 second. All right. So let's talk about some of these different types of liquidities before we tie it all together and discuss how to implement it into an actual strategy. Once again, sorry for asking. Why not use tick charts? What are you talking about, dude? I have no idea what you mean. What is fair value? So, fair value or fair value gaps are a type of liquidity. Okay. Now, the reason ICT coined the term, I think, fair value gap, it was, they've been around for quite a while. Slightly different interpretations, but same concept. And what they are basically areas where price goes to in order to achieve fair value. So when you have a lot of buying, and in this case, right, when you have a lot of buying, more buyers than sellers, and you don't have you don't have a battle between buyers and sellers, right? Like you do here, where price is green candle, red, green, right? There's sort of a battle between buyers and sellers here. When finally, in this case, you get way more selling than buying. If you looked at a footprint chart, what happens here is there are tons of buy orders, right? Everyone's trying to go long. Again, the market is driven off of liquidity. So there are tons of buy orders. Now, what happens here is not all of them get filled. And so there are orders left behind. And buying gets exhausted for in the interim, right? Temporarily. Buying gets exhausted and price comes back down here. Now, because there are lots of buy orders here, what ends up happening is when price comes back here, those buy orders get filled again to take price to the next level. If there wasn't this concept of fair value or repricing, then what you would see is just green candle after green candle all the way to the top, right? If the market is in now a buy program. But we know that can't really happen because there has to be a disagreement there has to be a disagreement at some point between buyers and sellers, and there has to be exhaustion from buyers, and there also has to be a bunch of buy orders left behind. So those have to get filled if the market wants to keep going higher. So once buying temporarily gets exhausted and you have now a little bit of selling, it sells into this area that has a whole bunch of buy orders before it goes up. That's what fair value is. Now, again, it's called, depending on which textbook you're looking at, it's called something different. I really don't care what term you use to define it as, right? But that's why these gaps exist. So a fair value gap is a 3-bar pattern, a 3-candle pattern, where you have a gap, right, or a candle in between the first wick and the first candle's wick and the third candle's wick. And in between that is a fair value gap. Now, it doesn't matter if these candles are red or green or some red, some green. Still, that's a fair value gap, okay? Now, one second. Not every fair value gap means something. As a matter of fact, most of them don't mean anything. And this is what separates someone who's just starting out from someone who understands the concept of liquidity, the concept of retracements, etc. Not every fair value gap means something. A lot of times you'll have a market where there, especially a trending market, where there's tons of fair value gaps, right? There's one there, there's one, there are so many here. That's so many that I don't even have time to draw them, but there's one there, right? And there's a lot in here. There's a lot right there. They don't all mean something. The only fair value gaps I really pay attention to are the fair value gaps that occur around an area where liquidity is swept and I'm looking for a retracement. So case in point, let's just take this example here where liquidity is swept. We break market structure. And we tap back into this area. You'll notice that there is a fair value gap right here. So you have a fair value gap and you have a breaker. And this right now is on the 5 minute. So we'll talk about time frames in a second. This fair value gap I care about, right? And that's, I'm really not going to be paying attention to, all the other noise that's on the chart. I'm paying attention to this because liquidity was swept, we broke structure, and we retraced to an area where there's confluence. There's so much confluence here. And there's a fair value gap here. Okay. Now, as I said, if you are a moving average trader, say for instance, right, and you want to ride this trend, because you notice that we're in an uptrend, and as I said, you have this RTH gap here, and you want to take a trade to the RTH gap, and you want to keep following the trend. If you look at this and you see that the price hit the 21 EMA, what do you notice here? There's also a fair value gap right there. So you can use fair value gaps as additional confluence regardless of your style of trading, right? Now, let me just remove this stuff here. As I said, the only fair value gaps that I really pay attention to are the ones that occur after a liquidity sweep when I'm waiting for a retracement in order to take an entry. And on occasion, if I'm looking to follow a trend, like if I think that, you know, buying is going to continue to the upside and I want to find an entry. So say for instance, I want to find an entry. I think buying is going to continue, and say that my target is here, this high, and I want to continue up. Well, we have a fair value gap right here. We also have a breaker right there. So this fair value gap would mean something to me if I wanted if I thought that there was a thesis that would take me to this drawn liquidity, this would be a potential entry. But there are way too many fair value gaps that happen that are that are meaningless, and don't really align with an area of entry. And those are the ones that you typically want to ignore. And by the way, obviously I'm going fast because we have limited time, but this stuff is flushed out over the course of many classes in the mastermind. But we have one class to take care of this stuff. I want to go back to time frames because the discussion here is relevant, okay? Before we go further, when I'm doing high time frame bias, I'm looking at the daily, I'm looking at the 4 hour. Sometimes I'm looking at the 1 hour, okay? When I'm entering trades, I'm looking at the 15-minute and below. So 15, 5, 3, 1. Now, I don't suggest that any noob look at the 1 minute because the 1 minute is going to give you, without proper context, the 1 minute is going to give you so many false signals. It's not even funny. And it's going to give you false fair value gaps. It's going to give you false market structure. It's going to give you false entries, right? So if you just look at this, let's just remove everything off here for a second. If you just look at this and you're on the 1 minute and you see that there's a fair value gap there on the 1 minute, right? You might feel compelled to enter there. There's one right below it as well. What the fuck is going on? There's one right below it as well. There's a fair value gap right here. So if you're just entering, if you're looking on the 1 minute and you don't have any context, it's going to give so many false entries. If I look at the 1 minute and I look at this looks like a market structure break. So I'm like, oh shit, market structure broke. I'm going to go short now on the retracement, right? It's even if you look at this, you're like, oh my God, we broke that low. On the retracement, I'm going to go short. The 1 minute is very dangerous for a newbie. Very dangerous because you don't understand that what the broader context is, right? And I think that if you're new, you really shouldn't go anything lower than the 5 minute because it's slow enough to where it allows you to not get duped by false signals. As you notice, there aren't any false market structure breaks on the 5 minute, right? It's just a series of higher highs and higher lows for this trend. And it's still fast enough to where you can day trade off it. Now, what are the times that I will go from a 5 minute to, say, a 3 minute? If I'm looking to enter, right, off of a fair value gap, and say, for instance, on the 5 minute, I don't spot a fair value gap, right? And I want to see if there is a fair value gap. Like say that we broke structure here and I want to enter, and say we don't have this fair value gap here. And I'm looking at this, I'm like, okay, I want to enter, but I would like to see if there is a fair value gap to refine my entry. Then I would jump to a lower time frame, like the 3 minute, to see if there is a fair value gap. If there isn't, maybe I'll jump to the 2 minute. Time frames are just tools. There isn't a right time frame to use. And I think that newbies get so obsessed with, I want an exact plan of what time frame to use when. And that's not how it works, right? If I'm looking at the daily and say I can't spot what I need to see on the daily, then I'll jump to the 4 hour because it's broken up. It's now twice as many candles as the daily, right? Instead of one day, it's now broken up into 4 hour chunks. And that might allow me to see something better. So same thing with the lower time frame, right? If I'm on the 5 minute and I don't see what I need to see because the candles are there's too much data in each candle, I need to break it apart a little bit. and I break it apart by going down a time frame. There isn't like an ABC, always use this time frame to do this. Trading is nuanced. It's not that easy, right? There isn't a always do this. It's what is my story? What is the context? And how do I use my tools to see if that is true? And can I manage my risk within that story? That's really it. All right, let's talk a little bit about market structure and change in the state of delivery before we get into strategy. Again, I know I'm going through this quickly. You can rewatch this later, but it's broken up and much slower and more coherent in the mastermind. But here's market structure. You have a series of higher highs and higher lows, right? In an up structure. How do we know that market structure is broken? When the last higher low is breached. Now this is a market structure shift. And you're expecting the trend to change. When you're in a downtrend, lower highs and lower lows, how do you know that market structure is shifting? When the last lower high is breached, right? And this is what you typically see when we get liquidity sweeps. That is it. This is a market structure shift. So when I go back to NQ here, again, my high time frame level tells me that that is a weekly low. Sorry, not that. Tells me that that is a weekly low. On the low time frame, let's look at this. Lower highs and lower lows. Clean market structure, right? Lower highs and lower lows. What is the last lower high that gets breached? That one. That's a market structure shift. And a retest of that lower high, this is the same thing as break and retest, support and resistance, whatever. That is what's signaling the trend change. Now, not only is it the market structure shift, it's where did we shift from? A key level. Remember, you want to look at previous day high and low, previous week high and low, previous month high and low. They're all important. And it's very easy to see them on the chart. As I said yesterday, demystify technical analysis. All you have to know how to do is draw a horizontal line. There, that's a low, that's a low, that's a low, right? So if price starts coming, so let's say that tomorrow, right, we swept this liquidity, so we're going to trade up. Where can we target? Well, we have this fair value gap here on the 4 hour, right? On the daily, I can't see that. Here's in practice why you would want to swap timeframes to see what you need to see. If price starts moving up, I'm like, where is it going? I can't just say it's moving up here. This is a daily chart. I have to break it up a bit. Oh, shit. Okay, now things are a bit clearer. Things are a bit clearer. So price can move into here. What if price moves into here and then starts rejecting? What am I going to do on that day? If it happens tomorrow or Tuesday, what am I going to do? I'm going to look on the lower time frame. This is high time frame, right? If we come in here and it starts rejecting, what is my mind thinking? My mind is thinking, where's price going to? Where's price coming from? Where's price going to? So if it starts rejecting here, then I'm going to swap to the 5-minute time frame to see if we have a market structure shift on the 5-minute time frame Because if it confirms a market structure shift on the 5-minute time frame, right? Then that, like, if we go to the 5-minute time frame, that 4-hour fair value gap is this. We drew it on the 4-hour and it appears right here. If price starts going into here, right? Let's say this is price. Come Monday, we dip into here and then we break this structure. What am I then going to do? I'm going to look for a trade short because I know what this level is. It's the 4-hour fair value gap. So let's say that we get into here and we start over the course of many days, obviously, because this is a 4-hour chart. Let's say we start going down. And price digs into here. And then we see that price is coming back up. What am I going to do now? This is the 4-hour, right? I'm going to switch to the lower time frame, whatever day this happens on. I'm going to switch to the lower time frame and see from this level, which I know is a major low. And by the way, what is this low? I look here, it says October 10th. That's the low from October 10th. Right? I look back. That is October's low. This is the monthly low. The problem that most traders who enter the market, even intermediate traders or traders who tried to trade for years, they don't think of the trade as the story. They're just opening up the computer and trying shit. They don't try to frame this stuff. They don't try to think about this logically because they don't really have the parameters, or they don't really have the tools to develop a story. But this is why I trade without indicators, because I don't need indicators to tell me that this is October's low. That's the monthly low. If we hit that and we start reversing, and I switch to the 5-minute, and all of a sudden the 5-minute, we get a market structure shift. Guess what? I'm going to take it long. Where am I going to take it long to? Well, maybe there's a 4-hour fair value gap here. Maybe there's we left a major high here on the 4-hour. You're just trading from liquidity to liquidity, and you don't have a trade without a liquidity sweep. If I don't see a sweep, I'm not trading. How's MSS different from CISD? You guys need to chill, bro. If you can't show patience here, how the hell are you going to show patience in the market? It's literally right here. Chill out. Don't make me turn off the chat. You guys have been behaving so far. I promise I'll turn off the chat. Krishna says, great explanation on trading break of market structure in conjunction with FVG with timeframes. I haven't seen that kind of detailed explanation even in paid courses. That's why I'm here, Krishna, and that's why you're here. All right. So we talked about market structure. What does it change in the state of delivery? Now, sometimes they overlap. Sometimes they don't. Meaning sometimes a change in the state of delivery is also a market structure shift. Sometimes it isn't. Okay? A change in the state of delivery, you have to know what the concept of order blocks are. Now, I'm not going to go in a detailed explanation of what order blocks are. I'm just going to tell you that order blocks are a block of orders somewhere. Now, the only order block that you need to pay attention to when you're starting out is the order block that happens at the point where liquidity is taken. Is change of the state delivery the same as MSS? My God, I'm going to kill this guy. All right. You can blame We Create Stories for ending the chat. Bye-bye, chat. Chat will come back for Q&A, but you can blame that We Create Stories guy. So when I have a liquidity sweep, right? In this case, let's just stick to this example. When I have a liquidity sweep, there is an order block that's created here. Now, what is an order block? It's just a block of orders that, like I said, the one that you need to pay attention to for now is the one that occurs at the liquidity sweep. So the way that I can summarize order block for you without making it too complicated is an order block is, let me just remove this for a second. An order block is the last series of red candles before an uptrend. So this right here is the order block. I'm drawing it like this because when I'm charting, I like to use the rectangles for gaps. And if I use the rectangles for order blocks, then I'll have too many rectangles on there. But essentially these red candles, the last two red candles before this uptrend, that's your order block. If there were 3 candles, it would be 3. If it was 1, it would be 1. Although I like to use a series, okay? And obviously when you're on different time frames, it's going to look slightly differently. Now, the order blocks, the higher the time frame, the more significant an order block is. So like a 1 minute order block is going to be these 2 candles. These are the last 2 red candles before an uptrend. Again, on the 1 minute, you're going to get a lot of fake outs, okay? So in this case, let's just stick to the 5 minute. I really will only trade a CISD off the 3 minute or 5 minute. The 3 minute CISD would be these red candles. The 5 minute is this. And in general, I don't use the wicks, just the bodies for the order block, okay? Now, where did we say that the market structure shift was? There. Why? Market structure shift is on, if we're breaking the downtrend, it's the last higher low that was broken. This one, that's the higher low. Notice where the CISD happened. The CISD happened down here. Market structure shift happened here. CISD happened here. You see that? And the CISD is when we close above this order block. So it was this candle right here that closed above the order block. Now, we'll talk about trading in a second, actual entry models and trading strategies. The reason that CISDs can be beneficial is you can look at the difference between this entry off of the breaker, basically the area where we broke structure, and this entry off of the CISD. If you measure this, My God, what the freak? You're talking about almost 100 points in NQ, right? What does 100 points in NQ represent? $2,000 per contract. In micro NQ, $200 per contract. That's significant. So the one thing I will say from my experience about this, CISD entries are earlier most of the time. Sometimes the CISD and the market structure shift will happen at the same time. Okay? Sometimes in this case, the series of red candles will be like, I'll give you an example here. Okay? Just imagine this. Forget that this happened, right? Imagine this is where your liquidity was swept, and this was your CISD because a series of 3 red candles. Your CISD and market structure shift would be in the same place. Sometimes that happens. Most of the time it's earlier. So obviously what the CISD provides is an earlier entry. So when we have this weekly low get swept and it's a major low, the CISD right here can confirm an entry. Now, the one thing I will say is that CISDs fail more than market structure shifts. So it's a trade-off between an earlier entry and higher failure rate. It doesn't mean it's bad. Nothing is bad as long as you're managing your risk. You know how much you're risking per trade. You know what that means for your account. And you don't tilt, etc. Nothing is bad. It's, do you know your risk? And are you managing it properly while accepting it? That's it. There's no bad, okay? Because yes, it has a higher failure rate, an entry from a CISD, as opposed to waiting for a market structure shift. The market structure is going to fail way less times, right? Because this sometimes, without the market structure shift, what can happen here is, this ends up sweeping liquidity, and you might have the drawn liquidity here, this weekly sell side. This might not be what the market wants. A lot of times you might be wrong on your drawn liquidity, and the market might have wanted this low, right? So if you take a look at in the shorter time frame, let's say you entered off of the CISD, we got this right here, this order block. We entered off of the CISD. We went long. The market swept this teeny tiny low here and kept going down because it maybe wanted this low on the high time frame. Very possible. So a CISD could fail in that way. It's a lot rarer for market structure to fail in that way. Not saying it's impossible. This is the market. Everything's possible. But this failure rate, because you're entering earlier before a market structure confirmation, you're entering off of a order block confirmation, and it's much earlier, it has a higher failure rate. But the chance that the market is now going to actually shift structure, it's going to be a lot rarer for then the market to fail this, if that makes sense. So that's the big difference between MSS and CISD. Not one is not better than the other. It's one can give you higher returns, but also more failures. The other one will give you lower returns and less failures. over time, I really think that you guys need to be journaling your shit on something like TradeZella. And that way, when you're entering your trades, right? Here's another tip, and I'm sure most of you guys aren't doing this. You would enter this trade. Say that you made money. Okay. You marked it down. One of the tags that you used in TradeZella was CISD. I should have put this actually in the I should have put here. Nice to have. I should have put. Actually, I can change it here. Some journaling software, and I do have a good discount on TradeZella as well. I need to hit you guys with all the discounts that I have. But say that you entered a CISD trade, it worked. One of the tags that you use for that trade is CISD. Say then you entered a trade off MSS, it worked. One of the tags that you would use for that trade is MSS, and you compile them and you'd see, man, I have a 25% win rate on CISDs and I have a 65% win rate on MSS. Here's how much money I made on CISDs, how much money I made on MSS. Over the course of many trades, the MSS trades were way better for me than CISDs. Now I know I'm going to stick to MSS trades, and that's going to be my playbook, right? That's how you have to look at your trading. I think the main trap, the main trap that people get into is they think this trade means everything or today means everything. You're looking at a broad amount of stats, and you want to compile a lot of stats, and then you want to use that to refine your entries based on what you trade, right? That's how your trading should be. It doesn't fucking matter what happens today. It doesn't matter what happens on this one trade. What matters is, are you tracking this stuff so that in a month I can look at 30 days worth of trades and be like, oh, I should do more of this and less of this. Got it. Now you do more of that, less of that. You tracking your trades. You look at your stats. Okay, my stats improved drastically. Great. I'm going to stick to this plan. Or I know I should have been doing what I said last month, and I see that I'm still entering on stuff I shouldn't enter based on what my data told me. So now I know I have to work on psychology, right? People don't think about their trading like this. They open the computer and they're like, how am I going to be fucked today? Or how am I going to be happy today? That's it. They don't think about anything else. And it's all based on your stats and then how you refine the stats to make them better. And then whether you're following your plans that told you how to refine your stats. If you're not doing any of that, you might as well just put your money in the S&P 500 every month and don't ever look at the markets again. Because that's what's required for you to actually win in this game. As opposed to every day just being, did I win or did I lose? It was a good day. It was a shitty day. Oh, no. That's not how it should go. Let's talk about Fibonacci real quick, because this is going to factor into day trading strategy, okay? Remember when I said that this trade here had a ton of confluence? Market structure shift. Obviously, all of it starts with high time frame. High time frame level. Which is weekly. SSL is sell side. All it means is the way that you can remember this is that these are the stops will all be sell orders to go long. So the bottom is sell side and the top, right? If price came up here, swept this and went down, these are all buy orders to take this down. So this is sell side, this is buy side. Really, sell side is demand, buy side is supply. It doesn't matter. Weekly supply, weekly support, weekly sell side, I don't care what you call it. Weekly level, market structure shift, retracement, right? So you have a retracement into that MSS. Let's pull up a fib. What do we have here? Oh shit, it's the 0.5 level. Magically. Fair value gap. So much confluence here. Moving averages. Oh shit, 21 EMA. Like, there isn't a right or wrong when you're trading, I promise you. Do you understand the picture? That's all it is. Do you understand the story that's going on? And can you manage your risk in there? That's it. Now, the Fibonacci is really special because it's a repricing tool that you can add on top of what you know about fair value gaps. If you're a moving average trader, you can add it to that too. Again, fair value gap, 21 EMA, 0.5 fib. Right? And what happens on every single time frame is that the market reprices to these levels that are also corroborated by the fib. And you can use the fib in conjunction with what you already know about the market. Now, I know traders that only trade off the fib. Whether you have a high success rate or not, I don't know about day trading. I certainly use it a lot in swing trading or finding levels to invest in, right? Like even when you look back at, say like the Qs, and on Liberation Day, where we stopped at, this previous all-time high, golden pocket of this entire range, that helped inform my decision. You can also use it in your day trading. Now, when you're day trading, what happens on retracements, as long as you're reading the liquidity picture correctly, is it often retraces or reprices to 50% of the move, right? So whether this area is important because there's fair value here, or whether this area is important because Fibonacci numbers also play out in nature, and this is 50%, whether it's both, who knows? The confluence often lines up. So a lot of times when you have, say in this case, where you have multiple fair value gaps, and you're trying to make a determination of which one to use, the fib can help a lot of times. Okay? But it is also a confluence tool that you can add on top of your entries. Now, the only values that I really use in the fib are these ones. 0.5, between 0.618 and 0.7 is the golden pocket. And then 0.786 is a deep retracement, otherwise known as OTE, like you see gold here in OTE. In this fair value gap, this is called an OTE retracement. We might have time to talk about OTE. I don't know. Either way, you can align your Fibonacci with your entry and see if a major fib level falls where you were going to enter into. How do you draw a fib? Remember that fibs always go from left to right. Always. There's no other way to draw it. You don't go from right to left. I don't start here and then end back here. I'm always going this way on the chart, regardless of whether I'm measuring a downtrend or whether I'm measuring an uptrend. Okay? Always. So I always want to go left to right, and know that fibs you don't only have one fib level. Like, you can use the fib it's like a ruler. You can use the fib to measure this entire thing. You can use the fib to measure this tiny thing. You can use the fib to measure this move up. You can use the fib to measure this move up. There isn't one fib level. As a matter of fact, on the entire chart, you have multiple fib levels, okay? So I was want to go left to right. And if I'm measuring how far a move is going to go down against this uptrend, then I want to start at the bottom and end at the top, meaning start at the bottom of the start of this move. And then where did this move stop at before retracing? That's the bottom, that's the top. If I want to measure this move, I would start at the bottom and end at the top. I would start here and end here. If I'm just measuring this move. If, say, price starts coming down and I want to measure this entire move, I would start at the bottom, and let's say we start dropping from here and end at the top, right? And based on my liquidity levels, if price starts coming down and I'm still expecting, based on my draw on liquidity, my read on draw on liquidity, I'm still expecting to hit that high, and price starts coming down, what do we have here? Fair value gaps, 0.5. So I may say that fair value gap's lined up with the 0.5. There's a low right there, an internal low. If we sweep that low and we get confirmation here, CISD, market structure shift, whatever, then I'm going to take it long to get here. So the fib is really an amazing tool that you can lay on top of your entries to see if it lines up. Okay? It's not to be used on its own. Now, as I said, you always go left to right, and in that case, we were measuring downtrends against an uptrend. Sorry, we were measuring down moves against an uptrend. It's the same exact way if you're measuring up moves against a downtrend. So randomly, let's just take this. We have this move and then a move up against it before going down. If I wanted to measure this, always go left to right. Right? And I want to measure how far up we go before going down. You can see that we're in the golden pocket here. But I still start left to right. But in this case, I start here and I end here to measure this up move against the downtrend to know where is it going to stop before going lower. Obviously, you have to know more. And it's not just a random, let me pull out a fib and short it. You have to be short biased. You have to, have a draw on liquidity down here, a reason to go short, etc. But it's just an added confluence that you can use on top of what you already know about the chart. All right. Let's look at day trading strategy now. How do we put it all together? Man, this is a lot. I'm really trying to pack in a mastermind in a couple of hours. Give me 1 second. All right, sorry. All right. Here are a couple of strategies that I use. These are really the main couple of strategies that I use when I'm day trading, okay, with futures. A little different with options. But this is a futures accelerator. So day trading strategy 1. First, I want to establish a high time frame bias. Remember, the high time frame, we're going to be using the daily and the 4 hour, sometimes the 1 hour, even though that can be in between high time frame and low time frame, okay? But I'm using a daily time frame for high time frame bias. What am I looking for? Same thing. I'm really looking to see where is the potential draw on liquidity. Where's price coming from? Where's price going to? Now, it's difficult to have a clean high time frame bias every single day. It's not that clear. And the reason why it's not that clear is because a lot of times on the daily, you'll have consolidation. So let's just take this. The summertime was really ugly, right? Let's just take the summertime, for instance. This cluster here doesn't tell you anything. So imagine like this looks like an entire month's worth of price action, and you're just really bouncing between previous day high, previous day low, previous day high, previous day low, and it's really not doing anything. And it's very different than, say, having a move like this where you have a V-shaped recovery and then a retracement. This was Liberation Day, by the way. And you have a retracement and you're like, okay, say you're on this day, right? And you see this and you're like, okay, am I bullish or bearish today? Well, it looks like this on the daily, we had all these equal lows. Liberation Day swept that, came above, and we're retesting. Maybe this is the start of a new bullish trend. Let me look at this. We're on the daily now. I can't see any fair value gaps here because remember, sometimes if your time frame is too high, everything's condensed. You might be able to find a fair value gap here, but it's not always, right? Like here's a fair value gap on the daily, but in this case, I want to see from here, is there an indication that this stopped somewhere significant? Because price could easily, right? If we hit this fair value gap, price could easily continue down. We don't know. So we're trying to make a determination. Does this represent something significant, and can I be bullish for the day? If you go to the 4 hour, remember, your time frames are just a tool. The daily didn't show shit. The 4 hour does show something. There is a fair value gap here because I split up the candles. Now I could see that there is a 4 hour low here, whatever that is. It is a form of liquidity. It's an internal low. It doesn't have to be the monthly low or the weekly low. It is a low protruding, right? So this right here, I know now that there's a 4 hour fair value gap. If I switch back to the daily, it doesn't show because the daily's too compressed. So now I'm starting to perk up. I don't know. It sounds kind of freaky. Okay, my alarm is going off that we have these equal lows that we swept and we are now retracing into something. And that something now I know is a 4 hour fair value gap. If I go to the 1 hour, it's you can even see in this case the 1 hour and the 4 hour are aligned, right? And so for this day, I'm starting to get bullish. Then obviously now we confirm on the daily that we have a daily market structure shift, right? If I didn't tell you what time frame this was, and I told you, if I told you this was the 5 minute and not the 1 day, you'd be like, oh, hell yeah, that's a market structure shift. Lower highs and lower lows. The last lower high closed above, right? So this is an example of very clean daily bias on these days where it is clear. Unfortunately, it's not like that every day. And sometimes you get these ugly periods of consolidation. So I'm looking to read the chart in the same way, right? Like where are the areas of liquidity and where price stopped, is that significant? So if I'm looking at NQ for tomorrow and I see that we swept that area of liquidity that we've been talking about, and I switch to the 4 hour, and I see that price is now moving up. We didn't even talk about IFVGs. We won't have, I don't think, time to talk about it. It is a fair value gap that basically gets closed above, right? So in this case, say that tomorrow we come into the market, we have this IFVG. We do know now we know what a CISD is, right? The series of red candles here is your order block. That's a CISD. And remember how I said sometimes your CISD will also be an area where you have a market structure shift? This is that example. So you have lower highs and lower lows, right? That's the last lower high. If we break this, not only do we have a CISD, but we also have a market structure shift. And this is an IFVG. So if we come into this day tomorrow, if this happens, would I be bullish or bearish? Bullish as fuck, right? Bullish as fuck. And where are we going to? I would target on the 4 hour this area of liquidity. So now when I'm on the lower time frame, that's the 4 hour up top. I know because I have it marked. Now, when we come to this day, right, and say that the market opens and does a manipulative move to sweep, say, London low or Asia low or something, and we confirm market structure shift or CISD, I'm going to take longs. And where am I targeting? I know this from the high time frame that that's likely my target. Right? That's how I want you guys to read the market. So all that was to describe high time frame bias, right? But really, we talked about all of this, but all of that was to describe high time frame bias, how I look at the market based on the high time frame. What am I looking for the day, shorts or longs? So in that case, my high time frame bias is going to, in the case that I described, is going to dictate longs. Now, we'll know tomorrow, right? But this doesn't have to be the end all be all. What if the market wants this low? Again, this is October's low. What if the market wants to sweep the monthly low before going higher? How will that look? This 4-hour fair value gap can get rejected, right? We can get rejected. We'll know by tomorrow. But if we start rejecting off here, where are we going to? That October low would be my next target. If we start rejecting here, then I go to the 5-minute. What if we get a MSS, CSS? What if we get a market structure shift and we start going lower? I'm targeting October's low. Another possibility is we go higher to that area that I talked about, this 4-hour fair value gap, and then we get a structure shift to take out October's low. Very possible. You don't know until that level is reacted to, and then you go to the lower time frame, which is what I'm saying here, high time frame bias. Then you want to go to the low time frame and look for a liquidity sweep. Right? So we're going to get a London and Asia session. Right? Say it's like this. And then New York opens and say we sweep London low and we get a market structure shift to go higher. Then I know that we are targeting that 4-hour fair value gap. And I guarantee you if I pull up a fib, that's going to be a significant level. OTE, optimal trade entry. So high time frame bias, look for liquidity sweep. This is on the low time frame. Bonus if that liquidity sweep aligns with a high time frame level. So sometimes it's going to be like London low. Sometimes the liquidity sweep that happens in the morning will align with like a 1-hour or 4-hour level. Market structure shift, which we talked about, and enter from a retracement. So if you get a market structure shift similar to this, you want to enter on a retracement. Usually that breaker level where we broke structure will align with the fair value gap, will also align with at least 0.5 of the fib. And that's your entry model. Target opposing liquidity. Right? In this case, if it happened here, I'm going to be targeting as my ultimate liquidity, that 4-hour fair value gap up above. But if you guys have been trading with us for a long time and you have multiple contracts, you definitely want to have multiple take profit levels. And if you realize those multiple take profit levels are oftentimes, all the time, areas of liquidity. So that high is a liquidity, that high is a liquidity. The 4-hour fair value gap would be the ultimate TP. Hopefully that makes sense. I just know, sometimes I know when a lesson hits. And even for those of you that have been trading futures, I know that this is a rejuvenating refresher. And maybe even a motivator. The day trading strategy too is the same thing, but instead of entering off of a market structure shift, you enter off of a CISD. It's the same exact thing, but you enter off of a CISD instead of a market structure shift. And that's essentially the way that I trade every single day. Now, well, I'll leave that. So here are the common traps that I see. Fixating on reversals in a trending market. So I see your guys' trades a lot or for those of you in the Discord, and I'll see that in a downtrending market, right? Like how we've had recently, a lot of noob traders will abandon all semblance of high time frame levels, and they'll want to see market structure shifts. They'll want to see CISDs everywhere, and they'll just continue to try to long this, right? So fixating on reversals as opposed to trying to trade with the trend is one of the main traps that I see. Now, I'm not saying you can't trade a reversal. You need confirmation, just like I showed you here, right? You definitely need confirmation. Secondly, thinking every trade is going to be a broad move. We kind of touched on this. You cannot have a broad target being your singular target every time. The market not only is moving from liquidity level to liquidity level on the high time frame, but in the low time frame, there are many areas of liquidity. And it doesn't mean that if you sweep this level, that then we are going back down to this low. If we get a reaction off here, you still have to make sure it's aligned with your high time frame, but it could just be a retracement back to a fair value gap before going higher. You really need to trade with confirmation. And you have to trade with your high time frame story in mind, right? Like if I'm taking a trade and my target is, say, on the high time frame, this 4-hour fair value gap, okay? And I'm taking a trade and the market reverses after hitting this high and I get confirmation and it starts to go down, then I'm like, fuck, is it possible that we just reject off of whatever this high is? Let me look at the high time frame. That high is that high right there. Yes, certainly it's possible. So I will have to continuously check with my high time frame to make sure that I still have a story intact. I can't just react to everything on the low time frame. FVG fatigue, we talked about this, but basically treating every fair value gap like it means something. Another common trap I see with trading futures is too tight of a stop. So because I think a lot of people are trading minis when they should be trading micros, if they're measuring, even if they're measuring a trade, let's just arbitrarily, even when they're measuring a trade and say that their stop should be say that you enter a trade and you know that your stop should be here, right? If you enter, let's say off of this CISD, and you know your stop should be here, but you look at this and you're like, holy shit, that's 60 points. That's $1,200. Fuck, maybe I'll just move my stop here. You might as well not trade. If you know that your stop should be here, right? Below, this is a fair value gap. This is the order block. if you know that your stop should be here, because this fair value gap, you want to put your stop at the bottom. If you're entering off a fair value gap, you want to put it off the bottom of the fair value gap, which are these 3 candles. If you know your stop should be there and your entry is here, then you should keep your stop there, but trade fucking micros. If your risk percentage, or if your risk per trade is say $500, but this is $1,200, then you should be entering 4 micro contracts, where instead of $1,200 for 1 mini, 4 micro contracts, your stop would be $480 instead of 1 mini. But the thing is, people don't do those calculations ahead of time. They don't want to miss out on trades. They get flustered. They're not practiced enough. So they'll just YOLO in with 1 mini, or they'll set a trade up with 1 mini, but they won't put their stop where it should be because they're afraid of that amount. That's not how it should be. You know your stop should be there. So the way to deal with that is to lower your risk per trade. And the way to do that is to take it with micros. And then the number of micros determines the number of micros you take will be determined by your amount of risk that you're willing to risk per trade, which is dictated by your stop limit. Moving your stop out of fear of it being hit. This is something that speaks more to psychology, right? I talk about this in the mastermind a lot, but the aspect of fear avoidance is essentially what most of you are doing in the market. You're trying to avoid pain. Sorry, pain avoidance, not fear avoidance. You're full of fear, but you're trying to avoid pain. You're not really trying to trade with a statistical mindset. All you're trying to do is make money, and you're trying to avoid pain in the process. You're not trading off of stats and excitement that you have found an A+ trade. You're just trying to avoid pain. And so you do a lot of dumb shit in the avoidance of pain. One of those is, if price starts coming towards your stop, you cannot accept that your stop is about to be hit. And the stop being hit feels so ugly to your soul that you cannot stand it. And so you remove your stop limit because you don't want it to get hit. You're trying to avoid pain. Unfortunately, you're causing your future self even more pain, because this stop makes sense for this trade. If the stop gets hit, likely the trade is not going to work out, and the market is seeking further liquidity. So if you remove this and you just start bleeding, you're not avoiding pain, my friend. You're increasing pain, but you're just delaying it. The pain that you will feel later is way worse than the pain that you're going to feel now if this stop is hit. It's not even close. Like, trust me, I've been there. I've done stupid shit on a Friday where I have to sit in and wallow over the entire weekend in pure anger because of how I ended the day on Friday. Or at the end of market close, where I'm like, fuck, man, I'm going to have to wait until tomorrow in order to resolve this, right? Or even worse, you spend Asia session or London session trying to get it back. The worst is trading at night. For me, the worst was trading at night, because I was so obsessed with the markets that I wanted to be involved in every trade. And so I would trade Asia session on top of everything I did during New York session. I would trade Asia, and Asia can be suboptimal. We didn't get to it here, but Asia can be a very rangy, trappy time zone to trade. I'm not saying you shouldn't trade it. Just familiarize yourself with it. It's different than New York session. And I would be down like thousands, sometimes tens of thousands. And I would, what am I going to do? What am I supposed to do now? Go to sleep? The fuck? I would be up all night thinking about it. Right? So the pain that you're trying to avoid now is going to be a lot worse if you do something stupid. Trust me. I know that from experience. And lastly, not focusing on overall stats, right? Like fixating on one trade or one day. As I said, you want to get something like TradeZella, and you really want to look at hundreds, better yet, thousands of trades. And this is why I say you guys should be trading a prop firm if you're new, so you're not blasting through your own capital. And it's not paper trading where you don't have skin in the game. There's still a monetary reward if you do things right. There's nothing like it, honestly. I wish it existed when I first started learning how to trade. But there's a monetary reward if you do things right. And if you do lose, it's not a whole lot. Fundamental cues. We talked about the news aspect of it. Overall market sentiment is really important. Knowing where we are in the market, right? Knowing that, for instance, back on when we were dealing with all the tariff shit, like knowing that can help you to ascertain whether, a bearish bias is warranted. For instance, here, it's not just the fact that you're dealing with tariff shit, but you overlay that on top of what you're reading, and you're like, I know what the overall market sentiment is here. Same thing when we're in an optimistic standpoint, right? Now, for this week, we're still coming off of a very shaky exhaustion gap and full filling of that gap. So I would not be surprised, honestly, like I said, to see the market now, especially if the government reopens. That these things you have to know, right? If the government reopens at some point next week, then and your high time frame bias is looking bullish, you have to factor that in, because it is going to have an effect on price action. So being aware of the overall market sentiment to overlay on top of your analysis. Risk management, position sizing. In my opinion, as I said yesterday, your risk size should not be more than 2% of your account. So it's going to be hard, dealing with, minis in this scenario. So if your account size is 10,000, you can trade on Tradovate, as I showed you, because the margins are very low for intraday, right? But 2% of 10,000 is $200. You cannot really trade minis doing this. You will have to trade micros. Now, if you're trading a prop account, right, and that prop account, say you're trading a 100K prop account, it doesn't mean that your account size is 100K, because on a 100K prop account on most prop firms, your max loss for the account before you lose it is minus $3,000. And this is what I tell people all the time. You want to give yourself the possibility of losing 10 trades in a row. So on a prop account, if your max loss is $3,000, you want to essentially take trades with $300 risk, because you want to give yourself the possibility of blowing 10 trades in a row to comfortably trade. You can, if you wanted to, buy eval accounts and try to YOLO them. That's not really trading. I'm just telling you what is actually trading and how you should approach this stuff. Because on a 100K account, your max loss is 3K and your target is 6K before passing. right? Meaning if you pass this, then you will get moved into a funded account, and now you can start withdrawing money if you're winning. So to get to this 6K target, if you're risking 300 and you're taking 2-to-1 trades, that means your TP is 600. It will only take you 10 winning trades to get to the target, right? And a lot of times your trades will be more than 2-to-1, depending on how far the risk or how far the TP is. So this is the formula that I suggest. You want to allow yourself 10 losing trades in a row. And depending on what your max loss is in your prop firm, depending on the account size in the prop, because there's usually 50K, 100K, and 150K. The 50K account, the max loss is 2,000. So you want to obviously alter this to match that. In terms of stop losses and profit targets, 2-to-1 is the standard in my opinion. A lot of your trades will be more than that. If you can't get 2-to-1 out of a trade, probably should not take the trade. So when you're measuring it out, if you can't measure out 2-to-1 on the trade, in my opinion, probably don't take the trade. Doesn't have to be exact, could be a little less. A lot of times will be significantly more. So routinely you'll find 4-to-1, 5-to-1 trades. But understanding expected drawdown in futures, as I said, it's always going to be exact. It's not like options, thank God. But in my opinion, one of the mistakes people do is they mark it in because they don't want to miss the trade. And then they realize that the stop limit is way too wide for their expectations. There's no reason, especially if you're starting out and you're trading on the 5-minute chart, there's no reason why you should not be setting up your trades beforehand. No reason. You have zero excuse. You should always be setting up your trade beforehand. And that way you know exactly what the drawdown will be and there's no surprises. Holy shit, we went through a lot, guys. I don't know. I'm going to go out on a limb and say that was the best condensed futures course that you've ever taken. At least the best one that I've ever seen. And I've been around for a long time. Hopefully you guys feel the same. We went through a whole shit ton. I was surprised. I thought there would be more people joining yesterday versus today. But as I said, this is only a few hours. Mastermind starts January 11th. And if you're not part of the Discord and you join the Mastermind, you get to have access to the Discord from now until the end of the year. And then from January 11th until we end the Mastermind in the beginning of February. But it's 4 weeks, 8 classes, twice a week. We go over technical analysis, options, futures, day trading. And it's a lot more, it's obviously a lot more info, but the pace is more manageable, in my opinion. So pinned comment or pinned link in the chat. You have to apply because we want to make sure that you want to be there. And if you get accepted, acceptance emails will go out. And you apply between by midnight tonight, then you will get the early bird Black Friday discount. It's actually a better discount than Black Friday. Black Friday will be more expensive than it is today. If we are on Discord, do we have access to these videos? Yes. Wait, which videos? The Mastermind? No. You will, even if you are a Discord member, The mastermind is separate. Will you have access to this video here? Yes. Will you have access to the mastermind? No. You have to be a mastermind member. This makes me realize I was not trading, but gambling. I mean, appreciate you. And that's big of you to, admit, to be honest. That's big of you to admit, for real. But I hope you guys enjoyed it as much as I did. If you guys have any questions about what I covered, let me know. Don't ask me about what I think about the market this week, okay? You can ask me that in the Discord. But if you have any questions on this stuff, let me know. The email I received said that it was today and tomorrow. Yeah, you should have gotten multiple updates to that email telling you otherwise. Did you not get them? If I missed yesterday's course, can I access the recording? If you're in the Discord, yes. If you're not in the Discord, but you were on the email list, it should be emailed to you. I had to sit through Asia session 3 days ago. Are the mastermind classes recorded if you miss them? Yes, they are recorded. And as long as you have mastermind access, they will be in the mastermind recording section of the Discord. Like if you have mastermind access, you will see this, and then you could just click on the recordings and you can watch them anytime, including the ones from previous masterminds too. What are the exact dates and times? It's usually Sunday at noon Eastern and Wednesday at 6 p.m. Eastern. But again, they're recorded. I did not get emails not in my spam folder either. A lot of people are saying this, and it's making me a little nervous. Does access to the academy mean we get to trade live with you during that period? Yes. Sumi, what's going on? Are there times you will use VWAP? No. Didn't get any emails either. Yeah, I'm not sure what's going on. For someone that's been trading over 1 year and who's a monthly member, would you say the mastermind's a thing for me? Bro, how do I know? How would I know? I'm not sitting with you and assessing your personality to tell you if the mastermind is for you. If this style of course was for you, then yes, the mastermind was for you. If you didn't like being taught live, then probably not. Otherwise, how could I know? But if you're on the fence, don't join, bro. That's why we have an application section to eliminate people that are on the fence, that are like, I need to know if it's for me. Can you assess my personality and tell me, please? How do I know, bro? Ask someone that knows you. Ask your wife. Did not get an email. Did not receive emails. Holy shit. That sucks, guys. My bad. I don't know what to do. TradingView discount. Yes, I do have a TradingView discount. Damn. So many people didn't receive emails. I don't know what to tell you. We sent them. It sucks, but I got the email, but it was for some guy with a different name than me. Yeah, it was probably your burner account. Are future mastermind refreshes included? Or does everything terminate after 3 months? We don't offer a lifetime membership anymore, but it's, you have access to them until you discontinue your membership. Do you have recommendations for prop accounts to look into? I would say that the cheapest one is Apex, and if you use the code TTT, I think right now it's 70% off. And then Funded Next. So there are different types of prop firms, right? There are straight to funded prop firms, which means that if you pass there are prop firms where you have to pay an activation fee if you pass the evaluation. And there are prop firms where it's just one cost. And if you pass the evaluation, there's no cost to activate it, if that makes sense, right? So in Apex, for instance, if you pass the evaluation, so you pay whatever it is, $50 for the evaluation. If you pass it, then you have to activate it, and that'll cost somewhere between $130 and $180 to activate it. And now you have a funded account that if you grow, you can withdraw money from. Some prop firms, you pay for everything up front. So you pay for the evaluation and it's more expensive, but if you pass, you don't pay an activation fee. So I would say that if you're not sure of your trading, to go the Apex route, right? Because the Apex route, if you're not sure you're trading, you will likely fail your first couple evaluations. And that's perfectly fine. At least you're not spending your own money trying to do that, right? Or much of your money. Whereas if you're sure about your trading and you know that you could pass evaluations and you've done it before, you likely want to go with a firm that will charge you everything up front and it ends up being cheaper. So like with Apex, you're paying $50 and then another 160 or 180 or whatever, versus like a Funded Next where you pay for everything up front. It's going to be cheaper than 200 and something. And if you pass that evaluation, then you just get transferred to a funded account without paying for an activation, if that makes sense. So if you use the code TTT in Apex, you'll get 70% off right now. So if you go to apextraderfunding.com, and use code TTT, you'll get 70% off. Does Tradevate has a prop firm? Well, you will select Tradevate as the provider. So they will give you Tradevate credentials to log in. And then you can log into TradingView with Tradevate using your Apex credentials, and you can trade in Tradevate. Can you explain liquidity sweep again? No. I spent an hour going over it. So unfortunately, no, but you can watch this again. Or join the mastermind where we'll go over it in detail.